Well, hello everyone and welcome to our webinar. I'm very pleased to introduce the presenters Brian Hall and Jayson Tolley from AMC's Strategy Optimisation team, who specialise in cut-off grade and Hill of Value evaluation. Shortly, they'll present some of the key learnings from 20 plus years of undertaking Hill of Value projects. But first, it's very exciting to announce that AMC's Hill of Value has been trademarked, which recognises our ownership of the Hill of Value process for mine strategy optimisation. It's been an absolute pleasure to have worked with Brian for 25 years. As a young engineer, I assisted Brian on the very first Hill of Value study, and since then I've had a front row seat in observing Brian's extraordinary generosity in imparting his extensive knowledge and experience on cut-off grades and strategy optimisation to colleagues, clients, students, and the broader industry. And I'm extremely proud that Brian's been able to impart his knowledge to the next generation, with Jayson now leading AMC's strategy optimisation team to continue Brian's great legacy. So over to you, Brian and Jayson, to tell us about 20 plus years of Hill of Value case studies and the next chapter.
Thanks very much, Andrew. I'm going to turn on the slides. I hope I'm turning on the slides. The best laid plans of mice and men. It worked a couple of minutes ago. Unbelievable. All right, we'll try plan B. So yeah, we're going to talk about 20 years of Hill of Value mine strategy optimization. And as Andrew has said, we've been doing this for quite a number of years, and we're passing on to the next generation, so to speak. We're going to talk about a number of things over the course of this webinar. We'll have a look first of all at the concept of it and some simple examples, initially just with a simple single aim, and then looking at perhaps one or two decision parameters which actually allow us to look at it in 3 dimensions pictorially. We'll move on and talk then about some multi-dimensional examples where we've got lots of decisions that we want to try and work with. We will then move on and have a look at having multiple aims, multiple goals, some of which may be potentially conflicting, and then how we deal with uncertainty and have a look at the trade-offs between upside rewards and downside risks, and how we might identify robust strategies as a result of that. And towards the end, we'll have a look at debunking some misconceptions, but particularly the primary misconception that more ounces means more value. Well, sorry, no, they don't. It's one of those weird and wonderful things that go on in our industry that a lot of conventional wisdom is unfortunately not wise. So when we're talking about the Hill of Value optimization process, we're perhaps saying, well, what's really going to give us value when we are looking to get the best out of our operations? And so we can then try to see, well, how do we make good decisions while taking account of all the various uncertainties that exist, particularly with regard to product prices, but lots of other things as well, so that we can achieve our corporate goals. So as an industry, we tend to focus a lot on things like, are we improving our productivity, getting efficiency right, getting costs down, and that's all good, that's doing things right. But the more fundamental issue is, are we doing the right things? And obviously, if we're doing everything really, really well, then we're going to be doing the right things right. But very often we focused on doing things right, in other words, being very efficient, but we forget about doing the right things, being effective. And so we are sometimes being very, very efficient at doing the wrong sort of thing. So if we have a look, for example, at a simple two-dimensional picture, first of all, where we just have cutoff across the bottom axis and value in some way going up the screen, then we will often see that we have an optimum cutoff grade. Down in this area here, the cutoff is too low and we're leaving out material or bringing in material that's destroying value. Up here, the cutoff is too high. We are leaving out material that adds value. There is an optimum. And this is just looking at one decision, the cutoff grade. There are lots of other decisions, and so there are multiple slices in this of this, if you like, coming out of the page at you for different mining methods, production rates, and so on. Similarly, if we go to the next slide, which is showing us increasing production rate, then we are in a position to say, well, it goes up and down a bit like the cutoff curve, but it's got these funny steps in it, and basically we come up against constraints. Down here, we're not using the capacity we've got. We need to do a bit of debottlenecking expenditure, which costs some money. Then we start to use it and we get increasing value. We then have some major debottlenecking capex, and again, we've got to start using it to get value. And the maximum will typically be at some point just before we have to go and spend some debottlenecking capital. And again, then there are other dimensions parallel to this, and so for different cutoffs, for instance, we might find that the point over at the right, the high point above the major debottlenecking capex, rises faster than the point to the left where the arrow currently is, and so the optimum production rate would change at different cutoffs. So as we go on from there, we end up with this, putting those two together, a three-dimensional view of it, and we can only understand and comprehend pictures of 3 dimensions. So we have cutoff increasing across the front of the picture. We have production rate increasing going back towards the back, and value increasing vertically. And this happens to be from a real-life example. We'll come back to it a little bit later and talk a bit more about it. But this is a real-life case study for an underground operation, and the value measure there is NPV. If we then go forward to say, well, where are we? What we very often find is that typically we start off at some point down here. If a study of some optimization study hasn't been done, then we're typically quite a long way away from the top of the hill of value, the strategy that is going to actually maximize value. And a typical response to knowing that you're not doing as well as you could be is to say, well, let's increase the production rate, and then we can spread the fixed costs across more tons, and that will give us a higher margin. So we go across to over here somewhere, and we find actually we've dropped from this sort of light blue band into the dark blue band. We're actually not as well off as we were before, because we've actually had to go through this capital spend to do some debottlenecking to get out to this arbitrary production rate increase that's been specified. And what also happens then is people say, oh, well, that's going to drop the cutoff, and so we can actually move from this point in the blue down to the left and end up down in the pink or off the scale. And I'm sure most of you listening will have heard something like that. If we increase the production rate, we'll reduce the unit cost so we can reduce the cutoff. And that's all based on an implicit understanding in our industry that cutoff is generated by a break even. And a break-even cut-off grade simply has the goal of ensuring that every tonne pays for itself. There's actually no guarantee that a break-even cut-off will even deliver a profit. If you think of a volcanic island out in the ocean and a coral atoll, the break-even cut-off effectively is telling you what the sea level is. It doesn't tell you anything about the height of the ground above sea level. And so a break-even cutoff is a bit like that. It's not telling you anything about the grade distribution of the material that's above cutoff. And it's that grade of material above cutoff that is actually generating value. So break-even as a concept puts us into all sorts of weird and wonderful places. It says we want to move from the red dot to the black dot and then actually move further to the left from the black on this square. Well, where we really want to be is up at the top of the hill. But we can do all sorts of back calculations for a whole range of different ways of determining cutoffs. But we can't do a back calculation from the top of the hill because we don't know where it is. The only way to find out the cutoff and the production rate and everything else that's going to maximize value is to do some sort of forward working, looking at the various permutations and combinations of all of these inputs. And that's essentially what the hill of value is. We are very good at doing sensitivity analyses where we flex the price or the cost or something of the sort like that, and we get the amazing discovery that if the price goes up, the value of the project goes up. Well, isn't that amazing? But the real question is, should we change the plan as a result of that? And so a lot of our sensitivity plots are plots of sensitivity of a fixed plan to changes in things that we actually have no control over. And that's interesting. That's useful information in many ways. But the hill of value is actually a sensitivity plot of value to decisions. And we're sort of limited again by our ability to only perceive things in three-dimensional space, but you can now perceive that if the price goes up, well, that hill is going to move up. If the price goes down, the hill moves down. So if the hill is moving up and down, that's what we expect. But the more important question is, does it move sideways? Does the top of the hill move across to indicate that we should use a different strategy with different prices? And very often, because of a whole range of other issues that we don't really have time to go into today, very often the hill will literally just go straight up and down. It will not actually move sideways as the price changes. But that's just net present value in this particular case. There are all sorts of other value measures that people are concerned about, and we'll talk about more of those over the course of this webinar. But as soon as we can plot NPV, we've got all sorts of other information. We can plot a whole range of other value measures or measures of parameters that are of interest to us. So, do we have to get the strategy precisely right? Well, the answer actually is no. Generally, it depends on what the shape of the hill is. So if the shape of the hill is something like this on the left, where there's a relatively broad, flat orange surface, well, that's okay. We can really select anywhere in that orange zone on the left, and we'll be fairly close to the optimum. And because of the uncertainties that are involved in a lot of our input assumptions, anywhere in that region is probably going to be reasonable. If you come over to the hill on the right, sort of like a church steeple or a witch's hat or something, then you've got to be exactly right. If you are not right at the top of the hill, you very quickly fall off the side, and the orange band on the left is up to about the middle of that sort of mid-orange zone on the right. So you very quickly fall below what you could have had with the hill on the left. So we rarely actually see hills that are like this. These are schematic to make a point, but we regularly see things like the one on the left, perhaps, where the hill is steeper in one dimension than another. So across the front, it's relatively flat. Across, going from front to back, it sort of comes up more steeply and drops away. But we also see very frequently that it is quite steep on one side of the maximum and not on the other. So those were schematics, but this is a real life one. And so as you look at the change in cutoff, if you go from the high cutoff, say in that grey band at the very top, and move to the right, it goes down a little bit of a drop and then relatively flat, but coming back to the left to lower cutoffs, big drop off very quickly. And so particularly with cutoff, where we have this desire to get more metal into the reserve, because there is this misperception that value is correlated with ounces in reserve, and we're always being pushed to get more reserve, we can very quickly push ourselves down into that fairly steep slope on the left-hand side of the hill. And similarly with production rate going from front to back, quite steep increase towards the front, but then as we move back, it flattens off. And so you can see there's that sort of a ridge running diagonally across the top, very steep on the front towards you, but quite a bit flatter on more of a plateau going back away from you. So here's a simple open pit case where we often find that the mill capacity has been locked in and the mining rate then has been set, and the tonnage grade relationships and the ability to move material on and off stockpiles with an open pit means that although with an underground operation like we saw before, the cutoff is actually quite a bit lower than it really ought to be, in an open pit, if you look at it, there's effectively a diagonal, a ridge of value running from northeast to southwest, if you think of this as a map with north to the top. And so given the mining rate that we happen to be working with, to keep the mill full with the best grade material, there will be some cutoff, and that's the red dot there across the base case mining rate. And so in open pits, very often the mining rate is too slow. We can actually increase the mining rate, the rate of total material movement in the pit, and improve the value by mining higher grade, by treating higher grade material earlier and putting the lower grade material then on a stockpile for treatment later on in the life. It's a time value of money thing, getting more money now and deferring the lower grade material to later. And underground, the access development rates are exactly the same sort of thing. Do we have to mine the decline now down this week, this month, this year? Well, no, but if you don't, you're going to have to take lower grade material from the areas that you've already exposed. In the particular case that you see here, if you again think of north, south, east, west, they ought to have gone northeast. They actually went southwest, south to reduce the mining costs, because they were being judged on their costs. And then, of course, having reduced the mining rate below that 100% line, they then had to move the cutoff down to be able to keep the mill full. And so, yeah, we reduced the costs, and that was good. Management got a pat on the back for reducing costs, but they actually reduced the revenue by more than the costs that they saved. Now, Ken Lane, some years ago now, identified the concept of balancing cutoffs, and this is basically where you have a cutoff grade that ensures that two parts of your system are operating at capacity, full capacity. So in an open pit, for instance, this is mining the maximum amount of rock from the pit and then sending the best available material of that to the mill to keep the mill full. So both the rock mining from the pit and the ore treatment through the mill are operating at full capacity, and the cutoff that determines what material goes to the mill is going to purely be a function of the mining capacity, the treatment capacity, and the tonnage grade relationship at that time, and it's got nothing whatsoever to do with price and cost. And so that's very often where mines will be operating that's often the cutoff that maximizes value. And that's why we were saying earlier, when you look at the price effect, the hill of value moves up and down, but it doesn't actually move sideways because we're actually being constrained by the physical realities of the mining and treatment rates and the grade distribution in the ore body. And yep, the hill of value just simply goes up and down with price changes. It does not move sideways. The cutoff, the optimum cutoff to maximize value, is independent of prices and costs. Here's a very quick and simple desktop study that we did many years ago. It was a pre-feasibility study that had been done for one scenario only. It was for 4-gram cutoff and 1.2 million tonnes, which gave us the black dot that is here now on this hill of value surface. And NPVs have been indexed to being 100 for what it was when we got involved in it. And just as a very quick and dirty desktop study, just using the information that was relatively limited in the PFS, to generate a hill and say, well, what if we could actually mine it a bit faster? We figure we can actually mine this a bit faster. Even if we stayed with the 4-gram cutoff, we could move up the hill from that line there between the blue and green bands. We could move up into the yellow or the orange. But the maximum value is coming if we went to a higher production rate, 1.5 million, and look at that sort of ridge of value that's coming out of the page more or less straight towards us. We could move up to potentially a cutoff of 6 grams and 1.5 million tonnes and get a significant value gain. As I say, this was a very high-level desktop study. Could we actually do that? We don't know. But at least it flagged the potential for significant value gain and the need to do a lot more evaluations rather than just look at one single point. Because initially all they knew was effectively that black dot with no idea of the shape of the hill and where more value might come from. Was the next hill, if we went and did a full study, going to look like that? Probably not. But what's the probability that that black point actually was at the top of the hill? On the basis of all of our experience, pretty low. There was probably going to be some significant value gain coming from a comprehensive study looking at what was going on. But what we will often find then with our studies, I said earlier that the cutoff often doesn't change, but it is not uncommon to find then that as we increase the production rate, we will find that the optimum cutoff follows that black dotted line. But particularly if we find ourselves then running up against some capital constraint and some bottleneck, there is effectively no production rate bottleneck on this particular plot here. If there was a production rate bottleneck, then we would typically find that wherever that bottleneck was, if it was, say, at 2.5, then at that point there on where the dotted line crosses the 2.5 production rate and the 2 gram per tonne cutoff, if we were then starting to flex price, we would find that that point just goes up and down without moving. Here is a plot then of a number of hills, plotted now in 2 dimensions, but price now is the 3rd dimension. So we've got cutoff across the horizontal axis and value, but the different lines that are plotted here now are effectively a 3rd dimension for price. And so you see that as the price increases, there is a small change in the optimum cutoff. The black dotted line going through the peaks of the hills are showing us a very small change in that cutoff. If we actually took the big red square as the optimum cutoff at the base case gold price, as it was for this particular study, and we changed those took that cutoff and then changed it in a break-even sense, in other words, by basically multiplying it by the $1,400 per ounce and then dividing it by the new price on each of those lines, then you see that the movement is quite a lot more dramatic when that optimum cutoff is varied in a break-even sense. You can't just take an optimum cutoff and then say, oh, well, we've changed the price, so divide, multiply it by the old price and divide by the new price, and there's the new cutoff. No. And that purple dotted line going through the small red squares is not the break-even cutoff. That is just changing the optimum cutoff by a break-even type of movement. So the break-even cutoffs are actually further to the left than the optimum cutoffs, and that line would then, that dotted purple line would then lie even flatter. So the optimum cutoff very often is relatively price insensitive. Here's another example looking at NPV and trying to identify a couple of other parameters, and this is for a porphyry copper, trying to work out where should the extraction level be and how big should it be. And so the ore body actually was getting narrower as you went down, sort of like carrot-shaped, if you like, almost an inverted cone going down into the towards the center of the earth, so to speak. And so getting narrower as you go deeper. And so there was going to be some sort of a trade-off then as to how wide the extraction horizon was going to be, the amount of waste that you would have to draw first before you started drawing ore from some of the outer columns. And so we used this hill of value here. It's almost a sort of a pseudo geometrical thing. We actually have elevation high at the top of the plot, lower, deeper at the bottom of the plot, and the cutoff that was being applied on the extraction horizon as the horizontal axis. And again, you can see there at 1% copper equivalent cutoff and 5910 elevation, that's about where you should be putting the block cave extraction level to maximize value. And these are, again, just simple examples where we are really just looking at a couple of decision parameters and one value metric. Let's move on and have a look at multiple decision parameters. And so on the next slide, we have an example. Starts off, and we're just plotting it in 2 dimensions here initially. Gold mine, cutoff axis, NPV indexed to 100 for where things started. We actually started here. And if we just looked at a single mine-wide cutoff, no changes over time, then it's this green curve here. And we say, look, there's a good probability of getting a 20, 25%, 30% even increase in value just simply by changing from some specified cutoff to an optimized cutoff for a mine-wide constant cutoff. If we then actually have a look, this particular mine had up to 25 or 30 mining areas, and we were looking at them basically just at each of these 5 cutoffs. If we then said, well, okay, what if we have different cutoffs in each mine area? That is actually 5 raised to the power of 30, which very simplistically is around about the number of seconds in the life of the universe as it's currently estimated at around about 13 billion years. That's how many permutations and combinations there are for 5 cutoffs in 30 mining areas. And we picked up additional value by doing that. One of the interesting things we found was that that actually changes the schedule so that when you, instead of having what we typically have, constant cutoffs and gradually areas drop out and the production rate gets less and less and less towards the end of the life of the mine, what we then find is that if we optimize the cutoffs, what it actually does is it increases them in some places and slows them down in other places, and your production profile, instead of having this long tailing off and eventually becoming uneconomic, it actually operates a square production profile, basically run at full production rate and then stop as quickly as possible. And when you've done that, change the cutoffs so that when you stop the mine, you have mined the best available material from every area. And so we see here, yes, there is, if you like, a general sort of trend. Here's the cutoff grades over at the side, 3, 4, 5, 6, shaded by yellow, green, blue, and purple. There is a bit of a trend of cutoffs getting higher as we go down, but it is not a continuous trend. You see there's some lower grade bits of 3 in amongst the 4s, there's some 6s in amongst the 5s. And this is all because of complex predecessor and successor relationships in the schedule, various constraints on truck ton kilometres, and constraints and ore tonnage constraints, both from the total mine and the individual areas. The optimum mine area cutoffs don't just simply increase with depth. They've actually been adjusted so that when the mine closes, we have mined the best available material from each area. We haven't run at a lower cutoff so that some of those, say perhaps those high grade 6 gram areas there in the middle, if we were running them at 4, then they would tail on out. And when we closed the mine, we would have mined a lot of material between 4 and 6 and still have left out then unmined material of higher grade. So by pushing the cutoff up to 6, we actually get the best available material when we close the mine and everything shuts down. So just because areas look similar and have similar costs doesn't necessarily mean that they'll have the same cutoffs. But yeah, multiple decisions there, because suddenly we go from having one cutoff axis to having 30 cutoff axes, 30 dimensions. Instead of being a 3-dimensional plot, it's suddenly 32 dimensions with 30 dimensions for cutoffs, 1 for each area, plus the overall production rate and the price. And the MPV as the value. So lots of ways that these analyses very quickly become complex multidimensional surfaces, and part of the skill then is working out how do we get to work out what's going on and present the important story to the decision makers. There is so much detail going on underneath these, but the trick is to get the important stories out. This particular slide here is showing us what happens when we have multiple decisions, such as the cutoff grade across the hill at the front there on the left, production rate going back on the hill. But then we also have a couple of points. There's the purple diamond and a light blue turquoise green diamond. And if we come across to the 2 little charts on the side there, where we're plotting, you will see also NPV against stope height, or sub-level interval if you like, on the bottom axis, and the 3 lines there then for discrete decisions, not continuous decisions. All the other ones, the cutoff grade, the production rate, the stope height, they're all continuous variables. We could actually select any value within that range. We've just looked at a number of them, specific ones. But the 3 lines then are for 3 different mining sequences or strategies. And so within that hill of value optimization that's shown in 3 dimensions that we can comprehend on the left, there are optimizations going on for these other parameters as well, to set what the stope height should be and to identify what the best mining sequence should be. They underlie or they are part of, that's if you like, expanding that blue and purple diamond on the hill on the left to bring in some additional dimensions. And so part of the issue is working out, what is the story that we're wanting to tell, and how can we present the story simply to people who have to make important decisions about what the strategy should be. Here's a case study with an underground polymetallic base metals operation. Very simply, it started off as being, by and large, a cutoff optimization. Production rate was in there as well, and so the curve here just showing cutoff is basically the best value that you could get at each cutoff for whatever production rate was necessary to get that. So we've collapsed the production rate dimension into this two-dimensional plot. But the other thing that's in there then also then is mining methods. The brown line for what we've called the old mining method and the green line at the top, the new mining method. But the reason for having two different mining methods was because we actually changed the value that we ascribed to each block in the model. They were working with metal equivalents because it was a polymetallic deposit, but the metal equivalents that were being used had been specified in a way that really smeared the value. And so for any particular metal equivalent grade that was quoted, there was actually quite a wide range of values. So when we that gives you the potential for misclassification. Material that should be ore is classified as waste. Material that should be waste is classified as ore. By changing the grade descriptor, the value that we ascribe to the blocks in the block model to say that this bit is better than that bit, that actually gave us a totally different picture of where value lay in the deposit, and that immediately suggested a change in mining method from horizontal slices cutting across varying grades to vertical stopes that mined out high-grade zones that were vertically aligned and left the lower-grade zones between them as pillars. And other things that you see, the sharp drop off at the right-hand side is real for that situation, because then those vertical high-grade zones, as you push to higher cutoffs, then broke up into smaller little lenses, and so we had to increase the number of sublevels, reduce the sublevel interval to be able to actually get to those smaller poddy ore bodies now instead of long vertical lenses. And so an increase in development costs, a reduction in values at that highest cutoff. But again, a significant value gain that's available. Here's one that is actually looking at the shaft to trucking to shaft hoisting transition. We're starting off as two-dimensional plots, but we'll move to a 3D plot on the next one. The curve that is there at the bottom, the solid reddish brown line labeled trucking only, doesn't matter whether there's a shaft or not. There's no shaft, so there's just the one line for trucking only, and it's showing an economic depth of somewhere around about 1,100 meters. We're giving a value in this particular case a bit over $60 million. The other curves then are for shafts that start when the production front, so it's a vertical ore body basically with production just continuously moving downwards, and each of the curves there then is for the shaft coming into operation when the production is at various elevations. And so we often see a desire to defer the capital expenditure for shaft hoisting for as long as possible. But what you're actually doing then is you are continually reducing the amount of material that's available to benefit from lower operating costs with the shaft to actually then pay for the shaft. The capital cost for the shaft is justified in two ways: by enabling you to go deeper, but also for reducing costs for hoisting, for moving material from underground to surface. And so what you find then is that if you put the shaft in, and so for this example, the shaft is just going to a fixed depth. We're not flexing the depth of the shaft in this particular case. That, of course, is something you could do. But in this case, you see then that with the shaft going to a particular depth, you can then have the economic depth of mining drop to about 1,600 meters. So you get about an extra 500 meters of vertical elevation that you can economically mine, but only if you put the shaft in soon enough. Because if you don't put the shaft in until the the operation is already working at around about 1,200 metres, then you see the peak value there is about 60. It is nowhere near. We've now dropped the value below the value that we have for trucking only. And so the longer we defer the shaft, the less likely it is that the shaft will actually be able to add value. So having a look at this in 3 dimensions, and unfortunately we're not able to build the slides to actually see what's going on here. The slide building, for whatever reason, isn't working properly at the moment. But here it all is in one piece. Here then, for on the axis going from front to back, is the depth of production when shaft hoisting starts, and the sort of tunnel-like curve there on the left is for trucking only, and so there is no shaft. So that curve is the same across all values for the depth when the shaft hoisting starts. But then the bigger hill on the right is the curves that we saw on the previous slide that are getting lower as that depth of production when the shaft hoisting starts is getting deeper and deeper. And so you have the red line that's showing the economic depth of trucking to surface across the top of that little tunnel. And then you have that brown line that runs as a contour, if you like, around the hill for shaft hoisting. And so that's in effect where the limit where shaft hoisting adds value. Anything in the front right section of that is saying you shouldn't be sinking the shaft at this point because you are not going to add value. And so in that sort of gully, if you like, between the red line on the top of the trucking only curve and the brown line that wraps around the shaft curve, in that gully, if the depth of the ore body only extends to somewhere in that region, say the depth of the ore body only goes to 1,300 meters, then if you defer sinking the shaft for as long as possible to defer spending capital, you're actually not going to be able to get the last 200 meters or 300 meters of material. But if you sink the shaft early, then you are going to be able to go to that 1,300 meters or even deeper to 1,600 meters if you subsequently discover the ore body goes that far. So if you're going to sink a shaft, you want to do it sooner rather than later in many cases. Here we've got several different outcomes. So this company's primary measure was NPV at 10%. The thin dotted small dashes at the bottom in blue. Somebody then says, oh, NPV, that makes you focus on short-term high grading. So what about total cash undiscounted? Well, that's the solid blue line at the top, NPV at 0% discount rate, slotted in the long dashes at 5%. They were also interested in their unit costs of production, which is the green line with the dollar signs on it, and their average ounces per year, of course, they were also very keen to know. So one of the things that you see is that discount rate has a bearing on the value, but what impact does it have on decisions? If your decision is what price do we want to buy or sell the asset for, well, then obviously the discount rate that you choose will have some impact. But if, on the other hand, you are looking for the operating strategies, what we then see is that if you want to maximize cash, NPV, all of those sorts of measures, a cutoff somewhere in the 4 to 4.5 gram range is going to be fine. The curves are all pretty flat there. You haven't got to calculate it to the third decimal place. So use 4 to 4.5 as a guide to say, let's find a good mine plan. If something's just a little bit below that, but it works very nicely into the stoping sequence, do it. If it's high, but it's not going to work in easily, don't go chasing it. Use it as guidance to make a good mine plan. If you want to maximize output and minimize unit cost, you're going to have a cutoff up around 5. If you want to maximize the life and the reserves, you're going to be down around 2 or lower on this particular scale. Free bit of consulting advice: if you want to maximize ounces in reserve, set the cutoff equal to 0. Mine all of the mineralized lithology. That will maximize the resource. That will maximize the tons or the ounces in the reserve. But you say some of those ounces are going to be losing money. Dead right, we say. So the only question then is, how much of the ounces that are in your current reserve are also losing you money? And the answer is quite likely quite a few. We'll talk about that very shortly. The illustrative hill of value that we looked at the beginning, it's apparently a simple decision. We want to move from the red dot to the green dot on the top of the hill, but there's generally more to it. So if we have a look, we're going to change that to a horizontal contour plot. So here it is now as a contour plot, and across the top of that we've plotted another hill, if you like. It's sloping ground rather than a hill. It is contours now of the mine life at each of these combinations of production rate and cutoff grade. And so we see out to the right, it's only 3 years, then 5 years. The peak of the hill is actually at 5 years. The original red point is out at 10 years. Management looked at this particular scenario and said, we cannot change from 10 years to 5 years. That's going to generate a whole heap of social unrest. We cannot, the unions, the town, that'll be it. We can't say we've suddenly reduced the life from 10 years to 5 years. But there's some sort of psychological hurdle at around about that 5 years. And they said, if we come back a little bit to the left of that, from the green circle back over to this purple diamond, we're still very close to the top of the hill of value. We've still picked up most of the value gain, but we now have a life of over 7 years, and we recognize that we can sell that without causing great issues. These lines also then, if you're not out where the end of the life of the mine, where that is an issue, going in the other direction, these lines in fact are indicating increasing vertical advance rate as we move from left to right. And that very often then will be a measure of technical risk. And so we might choose to say, well, some of these lines out to the right are actually indicating advance rates that we really think, although we've modeled them and it all looks okay, we know that we have troubles at particularly high advance rates. So again, maybe the vertical advance rate becomes a technical risk that we superimpose over it, as opposed to, if you like, the social risk that the mine life might be out towards the end of the life of any operation. I'm going to skip over this particular one, but we can talk about it if people want to come back to it, because I do want to talk quickly about uncertainty and the trade-off between risks and rewards. We're saying that a strategy optimization study should be done as an integral part of the pre-feasibility study to give you the best plan going forward. And at an operating mine, it's not going to fit into your annual planning cycle, and it's something that you should be reviewing each year for sure, but you're probably only going to redo it every so many years. If you are changing your strategy every year, there is probably something wrong with your planning. Long-term strategies shouldn't be changing every year. Yes, they might be adjusted, the tactics might change, but it should only be every few years where there may be some major changes that would cause you to want to change the whole thing. So it's very easy if we sometimes have just 2 points. We look at these and we say, oh, look, we've done an optimization and we have a point. We know what the maximum value is and what the cutoff should be for some particular base case and optimistic price forecasts. We may have used a powerful mathematical optimizer, and that's good. We're not decrying those. They are an important part of our toolkit. But you look at this and you say, well, what should we set up for? And because there's this difference in value between the brown dot and the green square, we'd often say, oh, look, there's so much upside there with the green square, we should set up for that. But the reality is that there may not be all that much upside. what we'll often find is if we set up for the base case and we get the better high price, if we put the curves through these, then we find we actually pick up most of the value anyway. So what we are actually looking at, the true upside for the setting up for the upside case scenario price, is that little green rectangle. But if we set up for that and the base case then comes in, we actually lose that red. So it's not a case of actually giving ourselves the option to move from the brown dot to the green square. It's actually the trade-off between the little green rectangle and the big red downside rectangle. But it gets worse. Here's a plot, quite out of date now, but still very up to date because the way metal prices change hasn't changed. The dark line is the actual price. The fine lines are the analysts' consensus predictions coming off that curves at the point where they depart. And so they were right to say when the price spiked it was going to come right down, but then all sorts of other things. And so for years and years and years, we see that the price predictions generally are optimistic relative to what's going on. The one sort of from sitting above the text there of January 94, yeah, they're fairly close in parallel, but still a little bit high. So let's come back to this curve then and say, well, okay, the green curve now is the predicted price and the brown one is what actually happens. And people are typically setting up then to the left of the peak for break-even cutoffs rather than optimized cutoffs. We are targeting something up high on the green curve, but we actually end up way down at the bottom of the brown curve when the real prices come in, and we wonder why as an industry we don't deliver good returns, because we are actually setting ourselves up by pushing the cutoff down to the left to get as many ounces in the reserve. We are setting ourselves up to fail time and time again. Very exciting being the mine manager when the prices are going up and down and you're moving up and down that olive green line. There's no kudos at all for the manager who's sitting up near the top of the brown hill and generating much, much higher average returns with much, much less volatility. They're obviously not trying hard enough because they're not panicking. So here's a real life example of that. This is an open pit with the maximum mining rate from front to back, the maximum treatment rate across the front, and in the hill on the left, the red dot is where it started, where the study had sort of started from. Yep, big is beautiful, go to the far back right-hand corner. But then let's have a look at the hill on the right, which is now at a significantly lower gold price, 2/3 of the base case. Same NPV index scale, but the red dot on this one now is less than 0. We have this little island of positive NPV in the middle of a sea of negative NPVs, and the best value there then is to stay at this base case treatment rate, mine faster and get better values, bring that back across onto the hill on the left, and we see, yes, we've lost a little bit of value, but we're still picking up most of the value gain that was available. And so we can work at that, the 250 million tonnes per year and the 60,000 tonnes per day point, and know that if the price goes down to even 2/3 of what it currently is, we don't have to worry, because we are already working with the strategy that is going to be good and safe and generate maximum value with that downside price scenario. So very quickly, just to say, geology, very often the geos will say, we don't have the information, but we can crunch it for whatever is there at the moment. And if we find that the peak of the hill of value is within the range, the geos are happy with the confidence of their models, fantastic, no extra work required. But if we find that the peak of the hill of value that we crunch initially is lying outside the range that the geos think their models are reliable for, we can see that there is a potential upside, and then it has to be a case of, does that extra value pay for improving the reliability of our geological models? If so, improve it. If not, then the maximum reliable cutoff is going to be the optimum cutoff. There are a number of other uncertainties, and any of those we can flex and take into account. We are often told we haven't got the information, so you can't model it. Well, that's illogical. The most uncertain thing is the price, and we wouldn't dream of building an evaluation model that didn't have price in it. If information is uncertain, build it in, flex it. Does it change your decision? If so, can we resolve the uncertainties before we actually have to make the decision, or can we do some sort of upside reward, downside risk trade-off like we did for prices there earlier? So finally then, this myth that increasing ounces is good. As we increase the cutoff from right to left across the bottom of this plot, the reserves are getting smaller. So we'll start on the right-hand side. As we reduce the cutoff, we increase the tons and the ounces. And we see that all our measures of value are improving, increasing cash NPV, increasing output, reducing unit costs. But after we go past the peak of the hill, more ounces results in reduced cash, reduced NPV, reduced output, and increasing unit costs. And we have never found an operation that is sitting to the right of the hill. Everyone is occasionally, if they've done some optimization or for very special reasons, they may be near the top. But if they haven't done any work, they've used break-even cutoffs, they are sitting out to the left, where any attempt to get more ounces in the reserve is going to destroy value, not add it. And so extra ounces from new discoveries is good, but extra ounces from pushing the cutoff down in the known resource is not. Jayson, I'll hand over to you to do a bit of a wrap up, but I think you should be able to move the slides from there. Otherwise, ask me to.
Excellent. No, thank you very much, Brian. So looking forward, what does the future hold for AMC's Hill of Value process? In a nutshell, we are really limited only by our imagination in terms of the number of strategic options and strategic combinations we want to model. We're also limited by computer processing power, which we can overcome by adding additional computers to support more complex strategic models, where we can run multiple strategic options and scenarios on multiple computers. What it really comes down to is basically, if you can describe it, we can model it. And any option can be modeled and evaluated regardless of whether all the information is available or not, as we can flex and test any range of these parameters as required. Now, even though there are similarities across mining operations, every operation has its own set of unique characteristics that may or may not be perceived as critical in the initial stages of the study. But it's important to model to ensure we understand the full impact on the overall strategy. And modeling any unique characteristic requires a certain level of research and development in every project. But as mentioned before, if you can describe it, we can model it, no matter how impossible it may seem. So when we want to expand on a range of decisions we need to consider, how can we better analyze the data relationships, and how do we present the outputs and results to key stakeholders? But how do we achieve this? We already have the basics built into our Hill Value model, with the proof of concept already in place and a proven track record in the strategy optimization space. But every project adds it to our toolbox where we can share within our strategy optimization team any additional smarts or new features to the Hill of Value model, which we can then take forward into any new project. More and more we're seeing advanced open pits towards the end of their life, mining final pushbacks with plans to transition to underground operations in the not too distant future. But when is the best time to make the decision on the optimal transition point? What often starts as a simple analysis becomes far more complex when we start adding all the what-if scenarios into the pit to underground analysis. Questions get asked, could we be constraining potential underground areas if we continue to advance the pit at depth? And also, could these areas be mined more selectively and earlier as an underground operation and potentially change the ultimate pit? We already have the proof of concepts for these in place, and we are continuing building on the optimization methodology to better inform this transition decision. When we talk about probabilistic analysis, we already have the fundamentals in place for a given set of inputs and assumptions for scheduling critical paths and other key variables. We already test a range of metal prices from an agreed base price. But what does this mean? When we change the price, do the hills move straight up and down, or does it move sideways, as Brian mentioned earlier, laterally with these price changes? If the hills are moving laterally with price changes, do we need to change the overall strategy? Overall metal price is just one of several value metrics we test through the Hill of Value process, where various percentiles of these value metrics are analogous. For geological uncertainty, via conditionally simulated geological block models, especially in the underground space, there will be a typical process for determining conditionally simulated geological block models which define the stope boundaries. And given these stopes, there will be a probabilistic tonnage and grade relationship which form the basis for the reserve at various cutoff grades. But how do we ensure you're going down the right path prior to reporting these reserves? With the Hill of Value process, we can model this underlying geological uncertainty, as well as simple uncertainties around metal price and unit cost, as well as other key parameters. But what are the risks and reward trade-offs associated with geological uncertainty? We can only start to answer this question if we include not only just measured and indicated, but also inferred and in some cases blue sky in our modelling to ensure long-term strategy and planning for these geological uncertainties in future. And as Brian mentioned earlier, if the information is uncertain, build it into the model. So how do we go about modelling system constraints? Advancements over the last 20 years in mining software has helped us to better understand system constraints. But with the black box nature of certain software packages, the level of understanding where the bottlenecks are in the system are not always well understood. Simulations are required to more accurately represent interactions of constraints and surge capacity between sequential processes in the operation. So in this chart we see here, let's assume we are mining an underground stoping operation with a single decline. What we see in the blue line there is an increase in the number of trucks, which increases the production capacity linearly. However, as we add more trucks to the system, we need to take into consideration the impacts of traffic congestion, ventilation limitations, and other operational constraints. So as we add more trucks, we start to see a drop-off in production capacity, which is what we see with the green line there. Now, as we mine at depth, we may need to upgrade our materials handling system to, let's say, a hoisting shaft or a conveyor system. In this scenario, if we develop a hoisting shaft, this becomes our limiting capacity, which we see with the orange line there. So adding more trucks only has a benefit up until we reach the shaft hoisting capacity or the total system capacity. So if we work from a simplistic assumptions without understanding the limitations of the full system, we may generate overly simplistic predictions. Taking into consideration multiple capital investments on a company's portfolio of mining assets, we need to understand what the impact of multiple capital investments will have holistically on the overall strategic decision or decisions to best distribute these capital costs. Ranking the base case and incremental expansion options by capital efficiency ratio, or simplistically NPV divided by the capital investment, as a key value measure helps us understand the best return on our capital investment of the company's operation instead of simply just maximizing NPV. Overlaying all these different types of value measures, such as NPV, capital efficiency ratio, sustainability, certain ESG measures, and mine life, as Brian mentioned in his example earlier, into multiple hills of value and various output combinations is key to ensuring we optimize the overall strategy. So to summarize, our Hill of Value process is a robust and comprehensive assessment of multiple input and scenario combinations to uncover all the available options, allowing you to make a more informed decision to achieve your preferred strategic position. As part of our Hill of Value process, we start with an alignment workshop to ensure we understand the corporate goals and that we have all the necessary inputs before we commence with the Hill of Value process. Prior to any Hill of Value modelling, we do a strategic options assessment to identify your preferred mining and processing options and what's going to be the best combination for the Hill of Value going forward. We can adjust key parameters to ensure the preferred strategy is on track once implemented. All right, there's Brian's book, which you can purchase an electronic copy for cut-off grade and strategy optimization from the link from the AusIMM website. Brian's book really does form the core principles and methodologies of the Hill of Value process. And before I go on, I do want to just say a big thank you to Brian for your many years of sharing your knowledge and expertise, not just with our strategy optimization team and AMC over the last 28 odd years, but also everything you've given to the mining industry for over 40 years. You truly are one of a kind, and the mining industry owes you a massive thank you. So thank you all for joining us today. This is the end of this presentation and the beginning of us continuing the work with all of you on mine strategy optimization using the Hill of Value for the next 20 years.
So folks, we're a little bit over our hour of the official time for the webinar. Thanks very much for your kind remarks, Jayson. I will be in Toronto next week for PDAC, so come and visit us at our stand. We can talk more about this. Happy to take, if people have to go, then by all means, thanks for your attendance. But we can certainly take a few questions if anybody wants to ask anything. So I'm going to stop the slide presentation. And so if anybody has any questions, you can either type them in the chat. Will the slides be available to participants? Yeah, John, we'll do up a PDF and make them available. There's some extra notes there from hidden slides, so yep, they'll all be there.